Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and sitting across from me, as always, is our resident numbers whisperer, Lana Chen. Lana, today we're cracking open ConocoPhillips, ticker SOP, and I have to say, this one's been on a tear.
It really has. Up over 40% year to date, and there's a lot going on under the hood. ConocoPhillips is the world's largest independent exploration and production company, and right now they're in the middle of integrating a massive acquisition while ramping some serious LNG projects. Plenty to unpack.
So let's start at the top. ConocoPhillips, headquartered in Houston, Texas. The current company was formed in 2002 when Conoco merged with Phillips Petroleum, but the roots go back to 1875. They spun off their downstream refining business as Phillips 66 back in 2012, and since then, COP has been a pure-play upstream operator.
And that's a critical distinction. Unlike ExxonMobil or Chevron, ConocoPhillips doesn't refine oil or sell gasoline at the pump. They explore for it, they produce it, and they sell it. Crude oil, natural gas, LNG, bitumen, natural gas liquids, that's the business. Operations span the U.S., Lower 48, Alaska, Canada, the North Sea, the Middle East, and Asia-Pacific.
The man steering this ship is Ryan Lance, chairman and CEO since 2012, petroleum engineer out of Montana Tech, over 40 years in the industry. He was actually named Energy Executive of the Year in 2025. The company runs lean too, about 9,900 employees as of year-end 2025, which is actually down about 16% year over year after some workforce reductions tied to the Marathon Oil integration.
Right? And that integration is one of the big stories here. But before we get into catalysts, let me walk you through the numbers. ConocoPhillips is trading at about $122.42 as of today, April 13th. Market cap sits at roughly $153 billion.
And for context, that 52-week range runs from a low of $79.88 all the way up to $135.87. The all-time high is $138.49 from November 2022. So we're not far from record territory here.
Not far at all. Now let's dig into valuation. The trailing PE is 19.4 times earnings. Forward PE drops to about 18 times, which tells you the market is pricing in earnings growth ahead. Price to book is 2.4 times, EV to EBITDA at a very reasonable 6.9 times, and the PEG ratio is about 3.0.
That EV to EBITDA number really jumps out, under 7 times for a company this size.
It does stand out. It reflects the market still applying an energy discount, but for a company generating this kind of cash flow, it's notable. Now, moving to income and growth, trailing 12-month revenue is $58.9 billion, with full year 2025 coming in at $61.5 billion. That's an 8% year-over-year increase, boosted significantly by the Marathon Oil acquisition.
Walk me through the quarterly trend.
Q1 2025 was the strongest at $16.46 billion, then Q2 pulled back to $13.98 billion, Q3 recovered to $15.52 billion, and Q4 landed at $14.2 billion. You can see the commodity price sensitivity there. Revenue fluctuates with oil and gas prices quarter to quarter.
Picture?
Trailing 12-month EPS is $6.35. Looking ahead, the Street expects about 7.9 for full year 2026, which would be a 15% jump. On margins, the gross margin is about 48%, operating margin is a strong 27.1%, and the net margin is 13.6%. That operating margin is really where ConocoPhillips shines as a pure upstream player.
All right, cash flow time. This is where the rubber meets the road for an E&P company.
Absolutely. Free cash flow came in at $7.24 billion for the trailing 12 months. Operating cash flow was much larger at about $19.8 billion, but capital expenditures of $12.5 billion take a big bite. The FCF yield works out to roughly 4.7%, which is solid. One thing to note, free cash flow has been declining from $11.5 billion in 2023 to $8.8 billion in 2024 to $7.24 billion in 2025, largely driven by increased capital spending on growth projects and the Marathon integration.
That's a trend worth watching. How does the balance sheet look?
Total debt is $24.3 billion, which did jump after the Marathon acquisition, added about $5.4 billion in net debt to the books. Net debt sits at about $17.4 billion. Debt to equity is a manageable 0.37, and debt to EBITDA is right around 1.05 times. Total assets are $122.6 billion. The current ratio is 1.30, so they're comfortably covering short-term obligations. Book value per share is about 51.61.
And the dividend story?
ConocoPhillips pays an annual dividend of $3.36 per share, which works out to a yield of about 2.75% at the current price. They bumped the dividend by 8% in the third quarter of 2025. The payout ratio is around 50%. The 5-year dividend compound annual growth rate is about 12%, so they've been growing it aggressively. Overall, ConocoPhillips' financial health is solid. Strong cash generation, manageable leverage, even after the Marathon acquisition, and a well-covered dividend, though the declining FCF trend bears monitoring.
All right, let's see what Wall Street thinks. The analyst consensus on COP is a buy, with 21 analysts covering the stock. About 41% have it at strong buy, another 29% at buy, roughly 24% at hold, and just one analyst with a sell rating.
The median price target is around $130, implying about 6% upside from here. But there are some bullish outliers. Piper Sandler's Mark Lear recently raised his target to $157 with an overweight rating. Wells Fargo's Roger Reed also carries an overweight with a $140 target.
Now here's where it gets interesting. Insider activity. And this one caught my eye.
It should. CEO Ryan Lance sold approximately 620,000 shares in March 2026, worth over $80 million. That reduced his personal stake by about 24%. Other senior executives also sold shares during the same period. And notably, there's been no significant insider buying in the last 90 days.
That's a lot of selling from the top. Not necessarily a red flag on its own. Executives have planned dispositions, tax obligations, diversification needs, but the magnitude and timing definitely warrant attention.
Agreed. On the earnings front, the last reported quarter was Q4 2025. They beat on earnings, actual EPS of $1.98 versus the 0.78 estimate. Revenue came in at $14.2 billion, which was slightly below the $14.5 billion estimate. For 2026, management guided production of 2.23 to 2.26 million barrels of oil equivalent per day, with capex of $12 billion and operating costs of $10.2 billion. They're targeting $1 billion in combined cost reductions.
Okay, let's get into the bull and bear cases. I'll take the bull side first. Catalyst number one is LNG. ConocoPhillips has a 30% stake in Port Arthur LNG through a joint venture with Sempra. Phase 1 is expected to come online in 2027, Phase 2 around 2030. They have 20-year offtake agreements locked in. Management expects this to drive over $1 billion in incremental free cash flow.
And don't forget Qatar. The North Field East LNG expansion is expected to start producing in the second half of this year. Between Port Arthur and Qatar, ConocoPhillips is building a significant global LNG revenue stream that should generate cash for decades.
Catalyst number two, Marathon Oil synergies. That $22.5 billion acquisition closed in November 2024. It added over 2 billion barrels of resource at less than $30 a barrel forward cost. Management has already locked in about $1 billion in cost synergies and is targeting another $1 billion by the end of 2026.
Catalyst 3, shareholder returns. They completed $5 billion in share buybacks in 2025 and are committed to returning at least 45% of cash flow from operations to shareholders. Combined with the growing dividend, the capital return story is compelling.
And number 4, the Venezuela optionality. In early April, ConocoPhillips sent a team to Venezuela to evaluate a potential return to drilling, about 20 years after their assets were seized. If the geopolitical situation stabilizes, that's a long-term resource upside.
Now for the bear case. Risk number 1, and this is the big one, is commodity price sensitivity. As a pure upstream producer, every dollar change in WTI oil prices impacts annual cash flow by $140 to $150 million. If oil drops below $60 a barrel, the math on dividends and buybacks gets much harder.
Risk number 2, that insider selling we discussed. When the CEO cuts his stake by a quarter and sells over $80 million worth of shares in a single month, it at least raises questions about whether management views the current valuation as stretched.
Risk 3. Execution risk on major projects. Port Arthur LNG is a massive capital undertaking. Construction delays, cost overruns, or offtake renegotiations could push back the cash flow ramp. The Willow project in Alaska is also critical to their cost reduction roadmap.
And risk 4. Geopolitical exposure. They operate across the Middle East, the North Sea, and Southeast Asia. Regional conflicts, supply chain disruptions, or regulatory changes could impact operations and project economics.
Let's do a quick peer comparison. Against the big integrated players, COP looks different. ExxonMobil trades at 24 times earnings with a market cap over $683 billion. Chevron is at 25 times earnings and $376 billion. Then there's EOG Resources, the closest pure-play comparable, at just 15.2 times earnings with a $77 billion market cap.
So COP at 19.4 times sits right in the middle, cheaper than the integrated giants but more expensive than EOG.
Right. But here's what's telling: operating margins. CHOP runs a 27% operating margin, very close to EOG's 29% and vastly better than Chevron's 8.8% or Exxon's roughly 12.5%. The pure play model is clearly more efficient. On free cash flow, Exxon generates $23.6 billion, Chevron $16.6 billion, CHOP $0.2 billion, and EOG $3.45 billion. Scale matters, but COP punches above its weight on a per dollar of revenue basis.
Dividend yields across the group. Chevron leads at 3.72%, followed by EOG at 3%, COP at 2.75%, and Exxon at 2.6%.
On leverage, Exxon has the cleanest balance sheet with a debt-to-equity of just 0.13. CHOP comes in at 0.37, Chevron at 24, and EOG at 0.31. All manageable, but CHOP's debt load did step up after Marathon.
On the options front, institutional traders have been showing bullish conviction. In February, 53% of unusual options activity was on the call side, about $726,000 in call premiums versus $270,000 on puts. And back in January, over 20,000 call options were purchased in a single day. That's a big institutional bet.
The strike range concentration was between $55 and $110, which suggests those were positioned well before the recent rally. Some of those trades have paid off handsomely.
All right, bottom line time. ConocoPhillips is the gold standard for independent E&P. A 40% year-to-date rally, a sub-$40 break-even cost structure, a multi-year LNG growth pipeline, and a management team laser-focused on returning cash to shareholders. The Marathon integration is on track, and the production base is diversified globally.
The one number I'd watch going forward is free cash flow. It's been trending down from $11.5 billion in 2023 to $7.24 billion in 2025. That needs to inflect higher as LNG projects come online and synergies fully materialize. If FCF reaccelerates in 2027, the thesis stays intact. If it doesn't, the buyback and dividend math gets tighter.
I love that. Let me close with this thought. The goal shouldn't be to own the stock that benefits most if oil spikes. It should be to own the business that can survive the down cycles and still reward shareholders. That's the ConocoPhillips playbook.
And whether it keeps working depends on whether oil stays above $40 a barrel, which, given the cost structure, is a pretty wide margin of safety.
That's our deep dive on ConocoPhillips, episode 118 of Charged Alpha. If you found this useful, subscribe wherever you get your podcasts. We'll be back soon with another name from the S&P 500.
And remember, we present the facts, you make the call.
This is Charged Alpha, the S&P 500 stock encyclopedia. This podcast is for informational and educational purposes only and does not constitute investment advice. Always do your own research and consult a licensed financial advisor before making investment decisions.
Ooh-wee do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.